Let me briefly introduce our panelists. Immediately to my left is Camille Bousset. She is director of the Brookings Race, Prosperity, and Inclusion Initiative and a senior fellow in governance studies, and she also has appointments here at Brookings in the economic studies and metropolitan policy programs. Camille has dedicated her career to expanding financial opportunities for low-income populations. She came to Brookings from CGAP, the consultative group to assist the poor, where she served as the organization's lead financial sector specialist. Previously, she worked for the Consumer Financial Protection Bureau, a U.S. government financial services regulator, where she served as the agency's inaugural head of the Office of Financial Education. And then to her left, we have Diego Molano. Diego is an international consultant in the area of digital transformation of companies and government. He was Minister of Information and Communication Technologies, through the acronym ICT, of Colombia from 2010 to 2015. And during his tenure, Colombia expanded all the elements of the digital ecosystem, not only infrastructure, but also services, applications, and users. Internet coverage extended to low-income homes in rural areas, 4G LTE, fiber optics, and high-speed networks expanded to all municipalities, even those in the middle of the Amazon. Every rural community with more than 100 inhabitants has an internet community center. Education, health, banking, and government services were transformed with ICT, increasing their availability, reach, and efficiency. So we're very privileged to have these two panelists with us, and so I'm going to start off with an initial question that I'll direct to Camille, and then I'll have a question for Diego and follow with some more. So for Camille, as mentioned a moment ago, you are the director of the Race, Prosperity, and Inclusion Initiative here at Brookings. Could you briefly explain why financial inclusion matters for traditionally marginalized communities, including low-income individuals and communities of color?
Sure. Thanks for the question. I'm really happy to be here discussing financial inclusion, not only globally, but certainly domestically. I think a lot of people are unaware of the fact that here in the U.S., we have 10 million people who are unbanked and another 25 million who are underbanked, meaning that they really don't have access to the full suite of financial services and products. And what that means here is a couple of things. So just generally, not having access to financial services makes it very difficult to save money, obviously, and to be prepared for emergencies, but also makes it very difficult to start investing and creating a foundation for wealth creation. And so when we don't have that, particularly in the United States, where leverage is really important to building wealth and particularly important to transferring intergenerational wealth, then not having these services and not being included in the formal financial service system makes it very difficult to make strides. And you see that here in the U.S. because a lot of the people who are not formally banked tend to be people of color and communities of color. And in the U.S., we have a very large racial income gap as well as wealth gap, and some of that is attributable to the fact that we just simply do not include a lot of African Americans, Latinos, and others in the formal financial system. So to give you a sense of that, in the U.S., for the median wealth accumulated by white households is $111,000, and for African American households, it's $7,000. So that gives you $7,000. So that gives you an idea of just the disparity and why it's so important to have folks included in the formal financial system.
Thank you very much. And Diego, given your expertise and experience in ICT, can you share some examples of ways that you have seen or expect to see digital technology transforming the financial services sector in Colombia?
Thank you so much for the invite today here at Brookings. As Camille was saying, we have many challenges in terms of financial inclusion everywhere in the world. One of the main ones is infrastructure. How do you get with banks to everybody? And through technology, that's the solution. That's what is happening, and I'm sure that most of you guys know the M-Pesa example in Africa, and many telecom operators around the world moving into that direction. But having access to technology is not enough. I mean, and we are proving that in most countries. For example, in Latin America, just around 50% of people are internet users, although more than 85% of people are already covered by networks, by broadband networks. Why? Because there is no applications for them. I mean, when you ask them why you don't use internet, they answered, it is useless for me. It doesn't change my life. So basically we have to work not only in deploying more infrastructure, but also in developing more solutions that really change people's lives. And that's part of what the financial sector is doing. So the financial sector is starting to use this technology, of course, initially for mobile payments, and then, some financial services. But not only that, the future of that is huge. In ID, digital identification of people, the impact in reducing poverty of digital ID is huge. There is a huge initiative led by the World Bank on that, and now the IDB is working on that as well, is how you make sure that people have an ID. If you see today, the financial sector is the one that has the power to create ID platforms for everybody. Secondly, land registries. Most of the credit given in the whole world is based on land registries. So now the financial sector has the power to move that to digital and help people in the base of a pyramid to get credit easier. Instead of going to all traditional paper state-owned registries, the banking service can also move to digital registries and transform completely the way credit is given today.
Thank you very much for both of your interesting perspectives there. So the next question is relates to the United States, and this is, as Robin mentioned, this is the third year in which we've been doing this, and we've been our project has been structured specifically looking at the set of countries that Robin alluded to a few moments ago. But as Camille reminded us, there's a very significant challenge here in the United States with, depending on how you measure it, some number of tens of millions of people either excluded from or at the margins of the financial system. And so it's a reasonable question to ask, what can we learn? So I guess my question is, what can we learn now that we have this incredibly rich tapestry of solutions that are being explored around the world, this global effort to improve the ecosystem? How can we perhaps bring some of those lessons learned and apply them to improve inclusion here in the United States? And I'll start with Camille, but perhaps, Diego, you have some thoughts on that as well.
Yeah, I'd really be interested in hearing your answer to that question, Diego. But at least, from my perspective, there are probably three areas where we can learn from the rest of the world. The first is in the regulatory arena. I think what's really interesting about the U.S. Financial services regulation is it tends to be very sectoral. So, you have communications regulation, the FCC, you have, different types of financial regulators at the federal level as well as at the state level. And so you have a lot of sectoral regulation, and it's really quite siloed. And I think what's interesting and what has evolved in some of the jurisdictions that we've been looking at in this report is that you see a melding of that, and you see some of a little bit more of a flexible regulatory approach, and I think that's actually really important. So particularly as technology is evolving, it's important to have coordination, at least coordination, with a range of regulatory authorities, so in telecommunications as well as banking, et cetera. And here I think we could learn, that's one of the lessons I think we could learn. The second is as Diego mentioned, this interesting area of overlap between generating digital identification and account opening, which India, of course, has done really well. Here, particularly for people who are underbanked and have significant documentation problems, digital IDs would be really useful. And I think that combination of the digital identification as well as providing more opportunities for simple, basic accounts, that is also something that we could learn from other places. And then finally, I think what a lot of the experiences have shown, both in sub-Saharan Africa and India, as well South Asia, is that there is a market for people who are doing very small, frequent transactions. And I think we need, here in the US, we need to revisit how it is we encourage innovation around that and how it is we regulate around that. Small but frequent transactions.
Thank you. Any thoughts for how the United States can improve our inclusion landscape?
Look, John, I'm not an expert in the United States, but that doesn't prevent me from answering. But this is very, very easy. You guys in the US have to go see what it is happening in the base of the pyramid of the world and go copy and paste. Copy and paste. Let, for example, fintech grow in the base of the pyramid of the United States, and it is growing in many, many, many countries in Asia, in Latin America. Go copy the fintech bill that it is presented in the Congress next week or in 2 weeks in Mexico. Let's try to see how that regulatory framework can be implemented as well in the US to tackle people in the base of the pyramid. The financial sector in the US and everywhere in the world, the traditional financial sector is focused on rich people. They are happy with high margins. Just very few banks in the world are really concerned about people in the base of a pyramid. Very, very few banks in the world are really developing new business with lower margins. So if they don't go, let new people go to that market. So adjust your regulatory framework as we are doing in the developing world.
Right. Thank you very much for both of your comments. This is a question primarily for Diego. It relates very specifically to Colombia. As everyone in the room knows, there's been a recent accord in Colombia ending a decades-long conflict involving FARC. And so there's certainly a lot of optimism in terms of the future of Colombia now that that accord has been concluded. And I guess my question is, what do you think the impacts of that will be in the inclusion landscape, given this very recent, in the historical context, this very recent development?
Look, I think it is going to be a different country. We're going to move to a different level, completely after 60 years of war, where we spend most of the budget in defense. Most of the Colombian budget was in defense until this year. For the first time in history, education is the largest budget. Why? Because we don't have to spend in defense because we have a peace agreement. Secondly, many areas, most of the country was a conflict, it was in the middle of a conflict, so developing business in those areas was very, very, very hard. So now we have the opportunity to develop business in those areas. Thirdly, the government has had a very clear policy on how to encourage the growth of financial services everywhere. And in 2010, when we drafted the policies on how to reduce poverty in Colombia, we joined forces between the ICT ministry and the finances and the finance ministry, and we said, let's first of all deploy infrastructure everywhere in the country. So today, Colombia is the best connected country in the region. We have fiber optics in almost 100% of municipalities. We have broadband everywhere, even in the middle of the jungle. So that's key, because that tool has to be part of the day-by-day life of people in those areas. In those areas that were affected in the conflict. But also, the government said, we have to encourage demand. This is not only about the supply side of it. We have to encourage demand. So all these subsidies the government is giving today to people, to poor people, that includes the subsidies for the former guerrilla members and for the victims of the conflict, are distributed through these new technologies and through these new financial services. And also, in order to encourage the growth of that demand, the government also changed the regulation. So new companies are now part of this game, and the whole country, I think, with these tools, the whole country is going to change dramatically in the coming years.
Thank you very much. So here's a question for both, but love to hear both of your thoughts. What do you think the greatest challenges are that the financial inclusion community faces in seeking to contribute to the sustainable development goals, such as poverty reduction and gender parity? I mean, that's a huge question. We could have, write a PhD thesis on either one of those. But to the extent that we can talk about it in a few minutes, your thoughts on poverty reduction and gender equality in terms of the greatest challenges. Right? There's been all this effort, over the last 5 or 10 years, but obviously we're a long way from having, enough poverty reduction, and we're certainly nowhere near gender parity.
Yeah, so I'll take a crack at it, and I mean, I'm sure there are about 15 things that we could probably think of, but let me just mention 3. The first is, I do think gender parity is continuing to be a very intransigent problem, and there are many reasons for that, but when we look at financial inclusion in general, women tend not to do very well. Even in countries where there are large advances. I mean, there are going to be some exceptions to that, Kenya being one of them, obviously. But if you look at South Asia, for instance, very, very difficult is financial inclusion for women there. The second thing is, I actually think that one of the challenges of financial inclusion is to figure out, both at the country level, but certainly the community of philanthropists as well, how is it that we link financial inclusion to economic participation and to social inclusion? And what are all the steps from getting, included in the formal financial system to getting into the formal, employment system to then getting some kind of social movement and social mobility. So I think those kinds of steps aren't well mapped out, and you can stall at several different nodes. So I think that's a real problem. And then the last thing is, for the ultra poor, I still don't think financial inclusion is as relevant as getting people stabilized to the point where they can then take advantage of financial services. And I think we still haven't really cracked how to do that kind of economic stabilization at a really kind of mass level. And I know there are a lot of experiments. When I was at CGAP, we worked a lot on graduation, which is a kind of approach to economic stabilization, but that needs to be much larger scale to really crack that nut, I think.
I think the main challenge is creating trust, especially with financial services. How you make these people that haven't had access to any financial service to trust a mobile phone? We all do it here. But how you break that barrier and create trust? Create trust of saving money or committed to pay interest on a loan or whatever. That's the main challenge for me to expand financial services to reduce poverty. So how we create trust between consumers and the financial providers and these new financial providers. And secondly, how we create trust between those new players and the regulators. And that's a tricky balance, We have to adjust the regulation, but we have to have the right balance. In countries like Colombia, again, having a huge narco-traffic problem, laundering money is a key issue. So regulators are not really keen to open the door because they may have, more laundering mechanisms. So we have to create trust as well between the new players or the new services and governments and traditional banks. What we have found in many countries is that the traditional regulation, it is too heavy for banks to go to the base of a pyramid. So also, not only having a new regulation for the new players, but a softer regulation for the current ones. That's key.
And I'll take the liberty of briefly stepping outside of my moderator role, and I can't help but mention when we talk about trust that's another reason why cybersecurity is such a really fun foundational part of the equation, and one which, at least in my view, has not gotten nearly the attention that it needs in this context. There are a lot of people who talk about it, but I think at ground level, there isn't nearly enough cybersecurity. And of course, if you're new to the financial system and your first or one of your first experiences with it is losing your money because the new solution you tried got hacked, then obviously that is exactly the opposite of what we want to have happen to build trust in these new services, new in the sense of from the perspective of the people who are adopting them. So trust is a really, really important issue. Okay, so let me ask a question. This is really for Camille, specifically your experience at the Consumer Financial Protection Bureau. Given that, do you have any thoughts about how to advance consumer protection and privacy in this increasingly digitized environment through the lens of or in the context of financial inclusion? In other words, as we deliver these services, but do so in a manner that provides the requisite levels of protection, and globally, even though obviously your personal work happened to be in the United States on this.
Sure. And before I answer that, let me just say the Consumer Financial Protection Bureau is the newest financial services regulator in the U.S. It was created in 2011 as a result of the financial crisis, and it really governs market conduct in the financial services arena. So. When I think about consumer privacy and consumer protection more generally for people who are at the base of the pyramid, I do, of course, think about trust, but I also think that the kinds of people who are just getting into the financial system for the first time are people who aren't used to, the marketing tricks, let's put it that way, or the ways in which their data may be used, et cetera. So they're just not really aware of the many ways in which a financial institution can make use of their data and can also put them in a fairly precarious financial position if something goes wrong, like a loan isn't repaid, et cetera. So from just purely at the privacy level, I think it's really important to explain to people what it is they're getting into. And there are many creative ways of doing that using visuals, et cetera. So I think that's really important. And it's important for regulators to be at the forefront of encouraging providers to provide that kind of education. I think the second thing is that privacy standards can really vary country to country. They can vary depending on the sector of the financial services provider. So it might be different if you're in telecom, and it might be different if you're in banking, and then different again if you're in fintech, right? So there has to be some way of harmonizing that and bringing those up to global standards. And I think there it's really important for regulators to conduct meetings where they are not only talking to providers, but they're talking to consumer advocacy groups. They're also talking to other regulators about how you do that kind of coordination. And particularly in areas like Sub-Saharan Africa and South Asia, I think it's very, very important to have a regional approach to that, because there's a lot of people movement for jobs, for economic opportunity. And so I think it's extremely important to have a harmonized approach, not only within the country and within various sectors in a particular jurisdiction, but in across regions as well.
Thank you very much. I have a question for Diego here. So as a reminder for the audience, we measured financial inclusion with respect to 4 key dimensions, which were country commitment, mobile capacity, the regulatory environment, and then actual adoption of these services. Colombia received a perfect score on the country commitment axis of those 4 axes in relation to financial inclusion. So we'd be interested to know what are 1 or 2 of the things that Colombia did to demonstrate this commitment to advancing financial inclusion.
The first one is clear policy. So we issued all the policies to include everybody. Secondly, deploying the tools, deploying technology so people can have access to it. Colombia is also #1 in technology affordability in the world. So this is not about only deploying the infrastructure, but also making it really affordable for people. Thirdly, the public-private partnerships. That's very, very important. So we went to the financial sector and the traditional one and said, look, we have to go to the base of the pyramid. What do you need? Some regulatory adjustments, both in terms of finance and telecom that we did. And for example, just out of that, just one bank, Da Vivienda, they deployed this product, the mobile payment product for people in the base of the pyramid. Now it is one of the largest mobile payment platforms in the world. More than 4 million people that didn't have a bank account now do have it through the mobile phone. They don't have to go to any bank branch to open an account. They can do it on their phones, and they can already pay e-commerce transactions. They can do a lot of things, and there are thousands and thousands of cash in and cash out points. So the traditional banking also played a very important role, but also other PPPs with the telecom sector or technology companies. For example, companies that had this business of charging the mobile phones with money, so like the prepaid cards and stuff like that. They moved also to the payment system thanks to the new regulation. So the penetration of payment services increased dramatically. But to increase the demand of payment services, we also needed a new way to increase e-commerce policies. So Colombia is growing very fast in terms of e-commerce, and this is not the traditional Amazon e-commerce. There are new players in the market that really adjust to the reality of Colombia. Companies like, there is a company called Rappi, because in Colombia people are very, very lazy. I mean, people don't go to the supermarkets, and there is a lot of bunch of mom and pop shops. So how you really connect those mom and pop shops with the consumer through this app? Today, Rappi is one of the largest e-commerce services in Colombia, and that really helps payment systems grow. And again, the government distributing the subsidies through those payments, that's part of the success of Colombia.
Great, okay. This is a question for both or either. What factors, I mean, of course, we all know or have read the various factors that can impact and help promote financial inclusion. And so, one way to look at it is the sort of, organic view, which is that the technology alone, coupled with people doing innovations is going to take care of it, and governments kind of, aren't as important as some people might suggest because so much of it will happen organically. Another viewpoint would be really more on the opposite end of the spectrum, that governments are really the central players and need to be the central players in promoting financial inclusion, and of course, then the solutions will follow. I guess I'd be interested in perspectives on the relative importance of leadership, of just simply letting the technology do its thing, of public-private partnerships, and what do you think, I guess, are the factors that are most fundamentally important or are there factors that are overplayed in their importance or are underappreciated in promoting financial inclusion?
For me, the main factor for the whole, not only for this financial industry, for the whole digital economy is talent. And we lack of 4 types of talent. The first one is the engineers. So that's a problem everywhere, including the US. We don't produce enough engineers, so we don't produce enough engineers that really develop new applications using the new for the new financial sector. The second type of talent that we lack of are women in the industry, and working women. And this is not about gender equality. This is about productivity. If women don't work, we are not going to be able to grow the economy, period. That's very simple. And I think in most countries that are doing this government subsidies that are focused on women, I mean, we've seen the positive results on that as well. I mean, empowering women to control the finance of homes, it's been very, very successful. But also we have to help them to really move to formal jobs everywhere. The third type of talent we need is that we have to change the whole education system. Today, an accountant that doesn't understand blockchain, it is worthless. You know, we have to develop.
There are some accountants who might disagree, but
So for all of you accountants out there who don't understand blockchain,
you have to go take it. You have to go get retrained on that. I mean, that's key. That's key. And so if a doctor doesn't understand what big data is, they are not going to be able to work in the new medicine. So we have to change completely the way we educate people. Every single profession has to have a little bit of a computer engineer. And the fourth type of talent that we need is digital leaders. We need leaders that understand this new economy and how to transform the current business into the digital business. And that is also part of what we have to do in the financial sector.
thank you. Camila, any thoughts?
yeah, in addition to what Diego has mentioned, you know, I actually think, having spent a couple of years at CGAP and kind of worked on financial inclusion for a while, I actually think intentional government policy is a really big factor. I've come to kind of really embrace that, and I think that's very, very, very important. I do think also that coupled with that, though, you have to have an environment that encourages and stimulates innovation. And that means you have to have a regulatory environment that also is enabling of innovation, but you know, also providing some guideposts and guide rails for how the financial system can evolve to meet the needs of base of the pyramid poor people. In addition, I think when we talk about financial inclusion, we mostly talk about expanding access to financial services, but I want to just put a plug in for responsible financial services. And so I think in addition to the other areas that I listed, I think you do need to have at least a basic consumer protection framework.
Thank you very much to both of you. And just, I may be telling many people what they already know, but just a quick reminder. So blockchain is the technology that underpins things like Bitcoin, but Bitcoin is merely one of many applications. Another term you may have heard is DLT, distributed ledger technology. So it's this idea that you can take a large number of computers, no single one of which is trusted, but yet sort of paradoxically create from that a network which in the aggregate behaves in a trusted manner. And it's a fascinating technology which has implications certainly in the financial sector, but with many other applications as well. So just want to make sure we're all on the same page with that. And so, okay, so this is probably a good time to maybe I'll do a wrap-up question, and then we'll open it to the audiences, to the audience questions. I guess what I'd ask is sort of a future kind of forward-looking question. Are you optimistic about, looking at sort of what's happened in the last 5 or 10 years? There's certainly a proliferation of solutions, and we've seen good numerical kind of progress on the metrics. Are you optimistic that we will continue to see, good progress, or is there a risk that we'll sort of, kind of plateau or fall back? I mean, what is your kind of candid view of the next 5 years of financial inclusion?
I'm very optimistic. I'm very optimistic because I think we have the tools, which is basically around technology. And we have also young people. Millennials, they already connected. They create that trust easier. So, and they are innovative on how to use that technology. So I'm very, very optimistic that financial services are going to be growing to the base of the pyramid and becoming a critical factor of reducing poverty. However, there are some risks. And as you mentioned, cybersecurity is one of them. That's very, very important. The second risk is how to manage consumer protection, data protection. That's very, very important because a breach of data protection or data privacy could really damage that trust.
So I'm cautiously optimistic. maybe a little less optimistic than Diego. So I'm optimistic that the services will grow, that the number of people who are covered will grow, will increase pretty dramatically. The caution is around a couple of things. The first is that I still think it's going to be very, very hard for extremely poor people to get into the financial services system, and I just don't think we've cracked that. I think it's also going to be very hard for women, poor women in particular, to be included. And still, I'm not aware of really big gains in some of the countries where that has been a persistent problem. So I think that's a problem. And then I also am cautiously optimistic because I think as you grow these services, there's also potential for scandal, right? And there's a lot of growth of digitally offered credit services, and that offers opportunities for scams and all kinds of consumer abuses. I think also the fact that credit bureaus operate a little differently and that might be opaque to consumers also offers opportunities for things to go badly for them. And then finally, the advent of using social networking data to make credit decisioning is a little creepy. And I think it needs some guide rails if we are to use that as a way of including more people in the formal financial system.
Thank you very much. So we'll open it up to any questions that you may have. So we have some microphones available. So in terms of if you have a question, if you just raise your hand, my one request would be if you could briefly state your name and which organization you're with. And my other request would be to please ask a question. So that would be, and to do it rapidly enough that we have time to answer the question. So anyone, the gentleman in the front is, and anyone else, you can raise your hand and we'll get to you. Okay, I see someone back.
Thank you. Larry Checo Communications. Bitcoin, an advantage or disadvantage to this whole concept of inclusion? And two, it seems that America here in the States, we're acting at cross purposes. CFPB is under siege right now, and I think it's been a wonderful, consumer protection agency that's been, and if not gone away with, it's going to be castrated. So how can we get more people in? Plus the fact that banks have not been honest brokers for a long time, and there's that trust issue that Diego talks about. So if you can just address those couple of things, thanks.
I'll talk about CFPB.
I actually might talk about Bitcoin too. So I think Bitcoin is really distinct from blockchain technology and distributed ledger technology. The latter two, I think, have some potential to be really interesting in the financial inclusion space, particularly as Diego has mentioned, when you're talking about using property as a way of validating who you are, et cetera. So I actually think that there's a lot of potential with blockchain and distributed ledger technology that could be very useful to property claims and all kinds of claims, and then also just validating who has done what with money, right? And also just maybe making it a lot easier and a lot less complicated to move money from point A to point Z. So I think there's opportunity there. On the CFPB, the CFPB has been a political football for a really long time. I think the folks who work there are used to that, and it does seem like the political terrain right now is pretty complicated, so that it's not entirely clear to me that given the list of priorities that the current administration wants to work on, that the CFPB would be at the top of that list. So.
Any thoughts?
I think in terms of digital currencies, very, very positive. I think they are a must, especially to increase the efficiency of central banks. But Bitcoin, I'm not sure. So I think central banks have to, learn how to operate and regulate digital currencies. It dramatically is going to improve the efficiency of the whole operation of money in the countries. But they have to work on a clear governance of those digital currencies. And that's the problem of Bitcoin. you know. So if you go to a central bank in Mexico or Brazil and you talk to them about digital currencies, automatically you talk to them about Bitcoin, they say automatically no, because they don't have any control of that. So creating a right governance, it is going to be complicated. But then to create that governance, you need talent to do that. And not only just the leaders of the central bank, you need the whole financial community to understand that. So you have to, again, go back to my point of talent. If people do not understand what blockchain is, nobody is going to support any initiative of moving to digital currencies with the central bank, or very, very few people. So in order to create that trust, we need people to understand the power of these new technologies and the security and all the implications. And also the regulation. We are moving from static regulation to dynamic regulation, and that dynamic regulation is going to be based on algorithms. Because today is just a very, very simple regulation in every part of the industry. The new economy is based on algorithms. The regulation is going to be based on algorithms as well. But how come you as a regulator are going to issue an algorithmic regulation if you don't know what the algorithm is? So we have to still work very hard on training people in this new economy and these new tools.
And just if I can add I've got a question there and here, but let me just add a quick kind of clarification, because when we're talking about these terms, there's sometimes some opportunity for confusion. A digital currency is, of course, you could contrast that with paper, but a digital currency is a class that could include a cryptocurrency like Bitcoin, but it is certainly possible to conceive of a digital currency that is not distributed in the way that Bitcoin is. So digital doesn't automatically mean it has to be Bitcoin. Now, it is certainly true that Bitcoin is an example of a particular class of digital currency, often called a cryptocurrency, where the management is in this distributed manner. And at least when I think of these things, I think of them differently, in the sense that I think that the governance issues of relating to centralized digital currencies, right? In other words, an entity like a government could issue its own currency and do it in a centralized way, but yet still digital. That is very different from a governance standpoint than a truly distributed currency like Bitcoin. The other thing I'll say about Bitcoin is I'm a big believer in the potential of the blockchain, but I also sometimes see its potential overplayed. I don't think that blockchain is the solution to all problems. And so there are use cases where it's a great solution, and then frankly there are some where it's really not the right solution, even though there's maybe some hype that suggests that it is. So with that, there was a woman in the back who had her hand up, and we'll go to her, and then after that there was. Yeah, so let's get the woman first.
Hi,
here, and then we'll go.
I'm Amina from the Philippines. I work with a microfinance institution that's trying to launch a mobile money program. One of the indicators in the 4 dimension is access and usage. And in our experience, those are two different distinct issues. It's so much easier to get clients signed up, but not so easy to get them engaged in the system. And part of that is what Diego was saying about trust and behavioral psychology and ecosystem. So my question is, for the 2017 report, how effective are countries in addressing this access versus usage gap? And in Colombia's experience, what has been good strategies and trend to make sure that people below the poverty line are not only into the system, but engaged and actively using it to leverage for opportunities?
The Colombia question, I guess that's...
Yeah, I think Colombia is, because this is not only about just giving access to technology or giving access to financial sector to technology, but also encouraging other applications using those financial services. That's key. So like e-commerce. So how you really encourage the growth of e-commerce, how you develop applications for small companies so that they improve their productivity. And part of that is using those financial services. So the financial services by themselves, or just basically payment systems by themselves, they don't move the needle. So you have to create the whole ecosystems of applications where they just play the role of moving the money, but there is going to be other values from those applications.
On access versus usage? Or?
No, I agree. I agree with the question that that's has really been an issue. I mean, you can have a lot of access, and and we've shown increasing access, but typically the numbers are that about, you know, 1/3 of the people who are actually signed up, you know, use accounts, and so there's a pretty big drop off, and so that means that for whatever reason they're not finding value, and as Diego says, it's about building value. But I think part of building value is really understanding what these customers need, and these customers are going to be very different from customers in higher segments, and typically the way financial services react to new customer segments is they take an existing set of products and then they try to move them down market, and without actually doing the research that allows you to know what the needs are and how you meet those needs appropriately.
And I guess I'll just add that, you know, the good news is that we've sort of wised up. You know, 6 or 7 or 8 years ago, you would have found some people, you know, focused maybe overly on potential access, just the number of accounts created, for example, as a metric. But I think, you know, very few people in the financial inclusion community today would use that number alone as any sort of a global success metric. And so what we often look at is, for example, if you've done at least a certain number of transactions per month, then it sort of counts, you know, more than if you simply have an account that you've never used. But it is a you know, core question. So thank you very much. I guess the gentleman up here, and then we'll go to the right, and then to the woman in the back. So, sir, to your right. Yeah.
Thank you. Henry Schiffman. I'm a consultant on legal and regulatory reform for IFIs. Another core question. I think Diego suggested that high margins were an obstacle to access to finance. But hasn't the experience been that all of these NGOs in particular, with what would be very high rates of interest for advanced countries, make access to finance possible? You know, in recent years, we're talking about 2.5–3% a month interest, and that gets funders to fund microfinance.
What I said was that the traditional banking was very happy with high margins, and the base of the pyramid has low margins. That doesn't mean that it is a barrier. Of course, you know, in an open economy, like you know, you choose what business you want to be in, but like what we are saying is, you know, when financial inclusion is growing, is in places where the new fintech companies are growing, you know, either they come from entrepreneurs or from telecom operators, or when banks say, let's tackle these new markets. As the example I talked about Davivienda, that they said, let's innovate, let's join forces with the fintech companies. And I think that combination of the traditional banking and the newcomers is very, very important, because the traditional banks, they know the regulation, they know the business. So they have a lot of value to really build together. So companies like banks like Itaú in Brazil or Davivienda in Colombia, they are really working on creating you know, alliances with these newcomers to tackle the base of a pyramid, and that's been successful. Thoughts?
No, I would agree that in a couple of different ways with Diego. First of all, I do think that at least globally, it's very difficult for banks to go down market and really service those people in a way that makes sense for them from a P&L perspective, unless they are willing to engage and partner with the fintechs or people who can bring the cost of service down, because you're doing a lot of little transactions. It's frequent. If it's not digital, there's a lot of hand holding. And so that makes it expensive. And particularly if you're not going to tweak your products to really work for poor people, then it's going to seem very expensive. Like the cost is going to just seem extremely heavy. I think where there have been some innovations, you know, actually East Africa, so Kenya, Equity Bank, for instance, has tried to put together a digital mobile money product. And now what they're doing, which is interesting, it's an interesting experiment, is they're getting rid of ATMs and kind of forcing people to use the mobile money products. And so that'll be interesting to see exactly how that works. But clearly what they're trying to do is drive demand for that and try to figure, and they've actually created that product for poor people. So I think, it'll be interesting to see how that works out, but I think you do have to create those products for poor people in order to figure out how you're going to work the margins. And then you also have to figure out how you're going to leverage technology partners to drive down costs. So I think, I would agree with you 100% on that.
So the gentleman in the same row.
Yeah, my name is Anupam Khanna. I used to be head of policy for NASSCOM, which is the IT industry in India. Just before my question, a couple of comments. We have found discussing issue of inclusive finance that we need to distinguish between financial inclusion and inclusive finance. Sometimes providing the services are not only doesn't do anything, it can actually be harmful. Mm-hmm. And here, this is where one comes into, I won't go into details, that you have to get back into some of the fundamentals of even issues like trust. A lot of people in countries such as India and all over developing countries trust banks and financial middlemen less than they trust the mobile phone. So our feeling that, they don't trust the mobile phone, no, it's the other way around. So that's why it comes back to what you've just said, which is that the, existing financial institutions are not geared and not interested generally to make the change. And in India, we've been trying for 10, 20 years. It was only when the new fintech people just sort of through e-commerce or whatever grew that we've got Paytms and others. But I won't get into detail, we can talk later. My question to you is, to what extent is the issue of identity, digital identity, a critical factor in inclusive finance or financial inclusion? As you know, in India, we have now put 1 billion people with biometrics, and it's become very controversial. Our Supreme Court has got it. People are worried about surveillance, etc. On the other hand, the issues are, should everybody have a social security number? It's really as fundamental as that. To what extent has that been a constraint in providing inclusive finance or not? I mean, that's really the crux of the matter.
Did you want to answer for Columbia? So I think it's been a huge constraint. I actually do, because, in many, many countries, people are very mobile. They don't have, fixed addresses. They don't have identity papers. All those things that are typically required by banks to satisfy, know your customer rules, AML rules, et cetera. So it becomes a real barrier, and so I do think it's extremely significant, and I can't stress that enough. And so I do think it's important to innovate in ways that will allow people who have those characteristics in that profile, basically, which is that they're very transient and they also don't have documentation to be able to sign up for bank accounts and other kinds of financial accounts. Yeah, I agree.
I think it is one of the main barriers or the main opportunities, to grow financial inclusion. The digital or identification, it is a way to track a person's life, to understand what they do, if they are trustworthy, whatever. But not only a person, an asset as well, which is critical. Most of the assets that are in the base of a pyramid are not registered today. So that's also an opportunity. So if you give a loan for a person in the base of a pyramid to buy a motorcycle or a car, having a detailed track of that asset is also important for the financial sector to increase the productivity of the financial sector. So I think it is critical, and the way. There are different ways to really grow digital ID. One is what India is doing, which is an initiative led by the government, a traditional initiative led by the government, so moving everybody to the digital ID. But I think one faster way to do it is through the financial sector. So joining forces between the government and the financial sector to create a common platform of digital ID.
Oops, and I can't help but respond to that when you use phrases like it's an easy way to track people's life. There's some people who would not necessarily celebrate that, and so
That's true.
And so they're just it's a double-edged sword, and so you can imagine very reasonable fears of not wanting to be in a system like that if that information could be misused. So anyway, I think we had a question in the back.
Over here, I think we had
okay.
David.
Okay.
Hi, David Medine, CGAP. One of the areas where digital finance has not really achieved its potential is consumer-to-merchant payments. That is, payments may be made to the consumer from the government, say digitally, as I think was suggested, to sort of get customers or citizens used to receiving digital payments. But then the citizens go to the agent or to an ATM and cash out and go to the merchant. That seems like an undue friction and cost of handling cash, but yet somehow there hasn't been merchant acceptance or customer demand to make electronic payments. Do you see that as an issue in financial inclusion, and if so, what can be done about that?
Go ahead. You go ahead.
So I'm going to say I think it's an issue for ensuring that access to finance grows in terms of the number of services that are utilized, right? But I do think that, so I think there are a couple of different points. The first is that you need to have an ecosystem of merchants who are willing to obviously use the system. And in order to do that, you typically have to have a platform, a transactional platform that people can plug into. So, and in some places that exists, in some places it doesn't exist, in some places it could exist, but it would be expensive. And so that kind of thing, obviously, like a switch platform or something, some sort of platform like that has to be ironed out. I think that with the growth of e-commerce, however, we're starting to see movement in some countries. So as you know, David, China and, increasingly India are sort of at the top of that list. But I would imagine that places like Kenya will finally, come on board with respect to e-commerce because you have a significant growing middle class that will transact there. And so I think you will start to get that sort of critical mass of businesses that are willing to, take payments online. And I think people will become more comfortable with that over time. But again, I'm not sure the ultra poor or really poor people will do that because I think really poor people still cash is king for them. And I'm not sure cash is going to be completely out of the system as a result.
That's exactly what happened in Colombia when we started to distribute the subsidies with mobile payments. We saw that 90% of them were cashed out in the next 2 weeks, massively in the first 3 days. So we understood that we needed to create that ecosystem. I mean, we needed to work with the local merchants, with the local mom and pop shops so that they can have applications using that money, that electronic money. But one main barrier here is the tax money. So those merchants are afraid of being taxed, because this is an informal economy. So you have to be really, really smart on what kind of applications so that they really feel comfortable that they are not going to move into additional costs, even those tax costs. So we created a lot of public-private partnerships to create those applications for the merchants. So we moved from 7% of SMEs connected in Colombia to 76% of them connected. So but the way we did it was just creating applications for them. So we worked with food companies, with beer companies, with all kind of companies that were doing business with those merchants to create an ecosystem. And I think we've improved a lot, that ecosystem. We still have a lot of room to improve, but we are moving in that direction.
I'm really glad to see a question from this side of the room. I was worried I was going to be accused of bias towards one side of the room here, but now we've got a question, so thank you very much.
Yeah, I'm glad. I hope it's worthy. Carl Pulzer, I'm with the Center on Capital and Social Equity. So I hear a lot of measures that are about liquidity. How many transactions, and that can be good or bad. Depends what the results of those transactions are. So I wonder, are there any experiments with measures that are more that of working capital or building credit? In other words, could you have an account that has a compartment, say 20% or whatever, where they have to keep it in for a while, and it's put in real working assets that could be aggregated, like a big index fund, and people could develop real collateral. And then that could be another measure. Does that make sense?
So in the U.S., there are products like that. There are some regional banks that have worked on, actually, interestingly, in markets where you have a lot of payday lending, that have worked on products where you keep a certain amount of the money in, you pay back a certain amount on the credit card, let's say, for instance. You build a credit score, increase your credit score as a result, and you can utilize the savings component as collateral for loans, et cetera. So those products do exist in the U.S. There are other payment cards, for instance, that have something similar, prepaid cards that have a component where you can save money. And so I think there is a recognition that just moving money in and out is not the goal of financial inclusion, right? The goal of financial inclusion is obviously financial security, economic participation, et cetera. And so there are, I would say, individual companies that have tried to provide those kinds of products that are useful for people who are trying to build credit or build savings.
I'm seeing new fintech companies doing that in the region. So, and that's key, again, of this fintech world. We have to let them grow and help them grow as well. So in the case of Latin America, according to a recent report of the IDB, there are more than 700 new fintech companies. And most of them are in this new alternative finance or payment systems. But there are like 15 or 20% of them, or like a bunch of them, working on how to create new ways of building credit records or I think, again, part of this is let them grow. Let them grow, it is very difficult for regulators. Very, very difficult for regulators to do that. But one way is creating, kind of sandboxes. So let's create an environment where they can grow, and we have kind of special or flexible rules for you to grow. And once you have grown, you have a little bit of maturity. Everybody understands the business, the regulator, and the fintechs, and then a new regulation could be issued to regulate that business.
And I'll just add to the thoughts that, you put your finger on a really important issue, which is sort of how do you measure these things? And one reason people measure just existence of accounts, because it's easy, right? You just ask how many accounts are there? And then, moving to measuring transactions, it's a little harder, but it's not too much harder. And if you try to look at some of the more sophisticated measures, it becomes even harder just simply to get the data. The other thing is there's not a one-to-one correlation. For example, you can imagine someone who is very included who almost never makes any payments from an account. In other words, they deposit things into the account balance goes up, and they're saving. They're not actually spending. But if you decided that because this person hasn't made a payment from the account in the last 60 days that they're not included or less included, then that would be precisely the wrong conclusion, right? So your question gets at this by definition, kind of impossible to perfectly solve question of what do we measure. But it's a great point in that we've measured the easier things, but not always the ones that correlate really with what we want. So it's a great point. We have time for maybe one or two more questions in the back, please.
Thank you. My name's Karen Shaban. I'm with Fairfax County Government. My question kind of follows on the data. You had mentioned early on the number of unbanked or underbanked people across the country in the United States. I'm wondering, is there a reliable source that if like a local government was interested to kind of know where their community was, so maybe they could target actions in a certain way, that they could drill that number down in a reliable way?
I'm not sure of more regional statistics, but the FDIC is really the one that has traditionally done a study around unbanked and underbanked numbers in the U.S. One suggestion I could make is that there is several cities have come together. They're called Cities for Financial Empowerment, which have coordinated their approach to financial inclusion. And so the main organization is actually based in New York City. I think it's co-chaired by somebody in New York City, and then the county, San Francisco treasurer as well. And so that organization should have some statistics on the more regional level, or at least the metro level. So you might be able to plug in there.
Okay, we have one more last question, and then we'll wrap it up. So right here.
Hi, I'm Judy Cochran. I'm with SIL International, and I really appreciate what Camille had to say about addressing the ultra poor. And around the world, those who are the poorest of the poor often speak minority languages that aren't even recognized by former financial institutions. And I wonder, to what extent did this report take language into account with regard to inclusion?
Want to answer?
Yeah, so I may be, so I'm not sure the best way to answer that. The short answer is we didn't pay a lot of attention specifically to the issue of language, with the understanding, though, that in many places the financial services are developed with specific knowledge of the local languages. But as you say, in many of these communities, there are minority communities who speak languages that are outside, and that is clearly a barrier to inclusion. And so that is another challenge. It's a great point, and I certainly wouldn't claim that we've really addressed it. But it's a terrific point. It's in many countries in the world we have this. So great point. So okay, well, I just want to express my thanks to our panelists and to all of you for a really terrific set of questions from the audience and really great set of perspectives from our panelists. And we'll welcome any of you to go take a look at the report on the Brookings website. And thanks again for taking some time to be here today.
Thanks, John.